You might be wondering, what can a letter from way back in 1997 really teach us about today's market? Well, it turns out a whole lot. We're about to dive into some absolutely timeless wisdom from Warren Buffett, pulled right from his classic 1997 letter to shareholders. And trust me, these are lessons that cut through the noise then and now.
So Buffett kicks things off with this, well, it's a fantastic and honestly kind of weird analogy about ducks. But you gotta stick with me here, because this one single image, it unlocks the very first crucial lesson in how he looks at success and failure. So what's this all about, right? This first lesson, it's really all about humility. It's about figuring out the real benchmark for your performance. See, it's not just about whether you're rising, it's about how you're rising compared to everyone else around you.
Okay, so here's the deal. Picture a massive rainstorm, or, a soaring bull market. When the water level in the pond rises, every single duck on that pond goes up with it. The duck that starts getting all cocky, thinking its own awesome paddling skills are what made it rise, well, that duck is just fooling itself. The point is, a rising tide doesn't mean you're some kind of genius navigator.
And this is where he just puts his money where his mouth is. In 1997, Berkshire Hathaway gained an incredible 34.1%. I mean, any other CEO would be throwing a massive party. But what did Buffett do? He looked over at the S&P 500, which rose almost just as much. So his own grade for his performance? A simple quack. He's basically saying that a passive duck, one that just floated along with the market, did almost as well as he did. Now that is some serious intellectual honesty.
And that kind of honest self-assessment leads us straight into lesson number 2, the incredible power of patience. In a world that is just screaming at you to do something, anything, all the time, Buffett champions the discipline of doing absolutely nothing.
And to explain this, he doesn't pull out some complicated financial model. Nope, he uses baseball. He tells a story of Ted Williams, one of the greatest hitters who ever lived. Williams had this secret. He mentally divided the strike zone into a grid of 77 little cells. And he knew with total certainty that if he only swung at pitches thrown into his absolute sweet spot, he'd hit 400. But if he started swinging at pitches on the edge, his average would totally plummet. So how does this all translate to investing? Well, your best sell is a wonderful business at a really attractive price. The low outside corner pitch, that's a mediocre company that's way too expensive. But here is the key, the absolute game changer. In investing, there are no called strikes. Nobody's forcing you to swing. You can literally stand there, bat on your shoulder, for days, months, even years, just waiting for that perfect fat pitch to come sailing right down the middle. All right, this next lesson, honestly, it might be my favorite because it just completely flips conventional wisdom on its head. It's a super powerful mental model for how you should feel when you see the market tanking. Buffett asks this deceptively simple question. Let's say you're going to eat hamburgers for the rest of your life, but you don't actually own any cows. Would you be rooting for the price of beef to go up or to go down? I mean, the answer's obvious, right? Of course you want cheap hamburgers. And this is where it all clicks. So many people who are planning to be investors for decades get all scared and depressed when the market falls. Buffett says this is nuts. If you are going to be a net buyer of stocks for the rest of your life, a market crash is a gift. It's a sale. It's your favorite companies being offered at a huge discount. You shouldn't be fearful. You should be thrilled. I mean, I just love this quote. He's literally giving you a practical tool, a mental script to run. The next time you see one of those scary headlines, just do this quick edit in your head. It's not investors who are losing. It's the people who are being forced to sell, the disinvestors. For every seller getting scared, there's a buyer getting a bargain. And for a long-term buyer, lower prices are a massive, massive advantage. Okay, for lesson 4, we're going to pop the hood and go a little deeper into the mechanics of Berkshire Hathaway. We're going to uncover the secret financial engine behind all its growth. It's a concept called float.
So what is float? Well, in classic Buffett style, he makes it super simple. It's money that Berkshire is holding, but that doesn't actually belong to them. Think about it. When you pay your car insurance premium, the company gets that cash immediately, but they might not have to pay out a claim on your policy for months, or maybe even years. That giant pool of cash just sitting there, that's the float.
Okay, so let's walk through this step by step. It's actually pretty brilliant. Step 1, millions of customers pay their premiums, all up front. Step 2, Berkshire takes that massive pile of money and invests it in stocks, bonds, entire businesses, all for its own benefit. And then step 3, way down the road, it pays out claims as they come in. It's a cycle that provides a constant, enormous river of capital to invest. But hold on, because here's the part that is it's absolutely mind-blowing. Normally, if you borrow money, you have to pay interest on it, right? But with insurance, if you run it well, the premiums you collect can be more than the claims and expenses you pay out. And when that happens, the cost of this float is actually less than zero. So for 30 years, from 1967 to 1997, Berkshire Hathaway was essentially being paid billions of dollars to hold and invest other people's money. It is, without a doubt, one of the greatest financial advantages in the history of business. All right, for our final lesson, we get another moment of incredible honesty from Buffett. This one is about one of his biggest mistakes, actually. It's about how he thinks about buying other companies and the hidden danger of giving away something great just to get something new.
I mean, just think about that for a second. This is a CEO admitting flat out that when he used Berkshire Hathaway stock instead of cash to buy another company, he actually made his own shareholders poorer. And it's not because the deals were bad or anything. The reason is much more fundamental.
And yep, we're going back to the ballpark to understand this one. The analogy just nails it. Acquiring a great player who can bat .350 is awesome for your team. But it's a terrible, terrible move if you have to trade away your superstar .380 hitter to get him. At the end of the day, you've actually weakened your team. So here's the takeaway. Berkshire's collection of businesses, that's a roster already jam-packed with .380 hitters. When Buffett issues new stock to buy a new company, he's trading away a tiny piece of everything he already owns. A slice of Coca-Cola, a piece of Geico, a bit of all these phenomenal companies. The price of admission for that new player is just way too high. He's trading proven greatness for something that is almost certainly, well, less great.
And that's it. Those are the 5 lessons. The duck on the pond, waiting for the fat pitch, wanting cheap hamburgers, the power of float, and never, ever trading your best hitter. You know, these ideas are from 1997, but they honestly feel more relevant today than ever before. So the final question isn't about Buffett, it's about us. In a world that is always pushing for more, faster, now, do we have the patience and the discipline to actually put this wisdom to work? That's something really worth thinking about.